correctly, and it's not even time yet, so we're in great shape. How the market's looking. Let's take a sneak peek. Ooh, almost 10,000. Coffee was a big surge. I was just complaining I was down 10,000 before, and now it's this is my total, not the today. It's up 10 for the day, but earlier we were way down here and decided to just add 2 more units, and I got it right at the bottom there. And fortunately, I brought my average down to 133, and then we blasted up over 133, so now it's at 34, and I sold 8 of my 10. So I was like, screw that, you know. I mean, it was really annoying. I was down $10,000 this morning. So now we're up $3,400. So take that money and be very happy with it. I'm going to keep it too long. I think it can still go to 150. But you know, when you go in, 2 is like 1x for me. That's like, you know, 2 is, I don't do 1 very often. The reason I do 2 is because if it suddenly shoots up on me, I like to then sell the extra one, and then I have a low basis on the first one that I bought. So that's the only way I really have 1 is if the only way I end up with 1 is if it accidentally goes straight up in my direction first, and then I sell the one to take some of the profit off the table. Anyway, so the bottom line is 2. So 2 is my base. So I wanted to be back at 2. This way now, if it goes back to 130, I'll be very happy to double down again. Instead of being completely freaked out, I just lose $10,000 for no good reason. So this money is basically locked in, $10,000 gain, and now we just have 2 contracts to play with. So I'm thrilled with that. I'm thrilled with the VIX being way up here. We talked about that this morning, and we'll start this thing first, and then we'll get back to all this stuff. Indexes, kind of a weak bounce. That's something else we can talk about. So the rough ride on last week's coffee trade, but now it's working out. All right, so Mr. Music Man, please. Will it change the interface? Ooh, I'm confused. Okay, let's see what happens.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, CSW, nor its affiliates, nor any of the respective officers. Personnel, representatives, agents, or independent contractors are in such capacity as licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. CSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or send your information to anyone.
All right, now we can get back to work. How's it going, people? CBI adjustment, please. Everybody wants to jump the gun all the time. Everyone's seen CBI. Oh, okay. All right, so CBI. First of all, where do we have CBI? This is what? Okay. We don't have it in the options opportunity portfolio. We should add it because now it's great. Now it's a great opportunity. It's not in the butterfly, so it must be only in the long-term portfolio. And in the long-term portfolio, we only have short puts. In the long-term portfolio, the only CBI we have is we sold 15 of the 2019 $25 puts, and we sold them for $5.20, and now they're $7.45, and the stock's at $20. So our net entry is 20, and the stock's at 20, and we have 2 years for it to go higher. So there, I've adjusted it. I'm not sure if you have another question. What is it? Because there's nothing to do there. When you take it, when you do a long-term short put, as long as nothing disastrous has happened to the stock that you don't want it anymore, you don't, you don't change through it. You don't do anything to it. Just it went down. Big deal. CBI is a good company. They make good money. It's a very silly sell-off, frankly. All right, so CBI. So they really, really fell off a cliff, but I don't really see it as being a very valid thing. I think that there's still the earnings there, and let's see if we can get them up here. CBI. What happened? Let's get a new computer. Thing is slow, and I don't know why it's slow. It's always slow. Didn't used to be fun. So they had their earnings. They missed, but they missed because if you look at it, I don't know if it's going to show it here, but again, I'm not going to sit here and do a whole research project, but oh, come on, really? That's on CBI. Okay. The main reason they had a miss is because a contract, 2 contracts that they had. I don't know if it's going to say anything about it here. Bottom line, worse, plunge. Profits were hit due to, higher cost, complete estimate. There were 2 construction projects, and they went over budget. CBI has to give an estimate to do a project, and sometimes they go over, and if they go over, they take a hit. So that's what happened. They had 2 projects that went over in this quarter. They took a hit on their profit. They still made money, but not as much as they thought they were going to make. But also, they have a huge jump. Oh, look. The company booked new awards worth $3 billion during the quarter versus $1.2 million the prior year. They've almost tripled their bookings. Okay, the win is attributable to the rebound in the key markets, particularly in the U.S., Middle East, and China. So they've got more projects coming online. They just happen to have in this quarter a couple of projects where they took a hit on them because they came in under budget. Now, when they do a project under budget, they make money. They give a quote, they do a project, and they try to hit their numbers. Sometimes they win and sometimes they lose, like a casino stock. But that's why they trade like a cyclical. Okay, they trade like a cyclical. Trade like a cyclical, as in their PE is insane. They make well here they make here they make 500. They haven't made money, but they make $500 million, lost $500 million, make $200 million. Their bookings are $12 billion here, $10 billion here. Their cash flow is fine. It's like it's up and down a little bit, but it's fine. But this company is valued at $2 billion, and they're capable of making $5 billion. They're capable of making $500 million a year. It's like any cyclical business, like a realtor or an E&P company. They're going to get a very, very low multiple on earnings, and in this case, their multiple is 4. They're capable of making 1/4 of their market cap in earnings in 1 year. But they won't make it every year. Some years they make it, some years they lose. We think that there's an infrastructure boom coming along. We think there will be eventually, if Trump doesn't get impeached, and even if he does get impeached, somebody's going to have to do it. The U.S. is going to start spending money on infrastructure. In fact, we have to, because we have $4 trillion of infrastructure projects that need to be done in this country to maintain the stuff that's falling apart, the roads, the bridges, so on and so forth. So somebody's got to do it at some point, or the country is just going to crash and burn. So over the next 10 years, I want to own Chicago Bridge and Iron, and whether they have a good quarter or a bad quarter at any given time, I really don't care. I'm a long-term investor. So at this point, the move we're going to make in Chicago Bridge and Iron, and not officially at the moment, but we're going to take these puts. Well, we're not going to do anything with the puts. The puts are fine, and maybe when 2020 comes along, we'll do something with them. But right now, there's no reason to change them. But these are fine, and then we'll add a bull call spread. So we'll go to our thingy, that's a technical term, and we will and we'll go out to January 2019, and we'll say, what can we do? It's $20 now. I can buy, I don't know if I want to spend that much. Okay, I'll buy the 1750 calls for $6, and I will sell, let's say, the 2750 calls. No, let's say it's 90 ambitious. Let's say we sell the $25 calls, which is where our puts are. We'll sell the $25 calls for $3. So for net $3, we're going to take not a $10 spread. We're going to take a 750 spread. 1750 to 25 is a 750 spread for $3. And we already have this. We already sold these guys for $5 for 25 puts. So if we do 50, we'll probably do like 20, and we'll do 20 of those. So we'll have an upside of $6,000 on the spread if we hit 25, and of course if we hit 25, we also collect all of the $15,000 we sold, not 15, the $7,500 we sold the puts for. Or actually the upside's more. Sorry, it's let's say 20 times 450, so it's $9,000. We have $9,000 we can make on the spread if it hits 25, and we'll make another $7,500 on the short puts. So that'd be $16,500 if they get to 25. If they don't get to 25, we own stock at about 22. I don't think that's a bad thing either. So, when you get to a thing where the downside does not in the least bit concern me, of course I want to make that trade. I'm like, what's the downside? Oh, you own Chicago Bridge and Iron for $22 long term. Oh, okay. That's my downside. So whenever you get into a trade like that and your downside is something ridiculously cheap. Now, when we first did it, we did this on 9/22. On 9/22, where were we? Where is it? 9/22. Okay, so on 9/22, we had first taken this hit over here, and we fell down to there, and we thought this was going to be a good deal back on September 22nd. We went up for a while, and now it plunged back down. But you know what? We didn't care when it was up. This is the thing, you guys. It went just as much up as it's now gone down. And I didn't care when it was up, and I don't care when it's down. But you guys, you freak out when it's down. It's going to go up and down many, many times in the next 2 years. Many, many more times in the next 20 years, and I would like to hold this stock. On the whole, I'm not worried about it. I'm worried about whether or not they have a viable business, not how they perform each and every quarter. You can't manage your portfolio that way. You've got to have a broader view of things. Again, it goes back to, I hate to keep bringing up Warren Buffett, but there's not too many guys like that who have a good long-term perspective on the market. And he buys Coca-Cola, and they have a bad quarter, and he goes, are people still drinking Coke? And they're like, well, yeah, everybody drinks Coke. And he's like, well, then who cares? They'll figure it out. Look at Volkswagen. I don't know what Volkswagen symbol is. Anyway, if you look, whatever Volkswagen, look up symbol. Oh, Volkswagen, VOLKS. There we go. Oh, this is a weird thing. Daily. Okay, right. So, no, it's not a long enough chart. Weekly. There we go. Look at Volkswagen. They had their emission scandal, and they fell off from 50 down to under 25. Since then, they're clawing their way back. Now they're at 32. They still sell an incredible amount of cars and make an incredible amount of money. It's just at this particular point they were out of favor. So do you dump it, or do you say, Volkswagen's still a car company. They still make cars people drive. They had a scandal. They're going to say they're sorry and pay a fine, and then they're going to move on and keep making cars. Toyota, too. Toyota had crashes and safety issues and wasn't braking or whatever crap. Sony had exploding laptops. BP had a big oil spill. Things happen. It's always something. I've run many businesses. I've consulted on hundreds of businesses. Things happen all the time. That's why I get paid to consult. Okay, they don't call me when things are great. Usually, they usually call me when something's wrong. I don't know the kind of consulting I do. I'm an efficiency consultant. I do M&A consulting and efficiency consulting, and so when they need to improve the businesses, when they call me, they don't usually call me when things are running smoothly. There's always something. And there's always ways to make it better. And unless your company is a fundamentally flawed company that makes a product nobody actually wants anymore, you can figure out how to make money with it. It's like Twitter. Like, everybody's down on Twitter, and I was saying, look, they got 400 million users. They'll figure out some way to make money with 400 million users. Eventually, somebody's going to have a little light bulb go off in their head. I could think of 10 ways for them to make money. And you just gotta get into a company. You've got to get in for the right reasons and stay in, not just get in and out every time the frickin' chart changes. The chart is not the company. The chart has virtually nothing to do with the company. It's a popularity. It's a measurement of popularity. That's all it is. Just like a high school girl. I got two of them. They get popular, they get unpopular, they get more popular, they get this and that. They go in and out of groups. It means nothing. It's the same damn person day after day. It's just the trend changes and and things go up and down. They got a boyfriend, they don't have a boyfriend. So, it doesn't mean anything. What matters is whether or not the actual company itself is making progress and doing what it needs to do. Are we sticking with up? We are sticking with up for now. We'll see what happens with the dollar. If it's not going to recover, if it's going to recover, it can recover very quickly. If it's not going to recover, then we're throwing good money after bad. So there's only two possible things, and neither one gives us a reason to really do anything right now. Tesla, can we talk through it? I still have the June 17, 300 calls. I sold at 15.5, and I was thinking of rolling. What do we have? I don't even remember anymore. We have the June 300s. That doesn't sound that good. That would be in our short-term portfolio. Oh, wow, look at that. 348. What's that, up like 25,000 a day or something? Doesn't take much of a sell-off for that thing to make money. Where were we? Was it yesterday? It's yesterday. We just did a review. Hang on, I'll tell you how much we made today. Why is this page not expanded? They all expand when you do that. So yesterday, Control F, STP. There it is. We were at 426 yesterday, and now we're at, not so much, 448, 22,000. So still the 22,000 bucks we made today on this little tiny dip. So now we know how bearish we are. We get a 1% market dip, we make $22,000. There's a limit to it, but in a 10% market dip, we can make $200,000. That's how much protection we have on our thing in the short-term portfolio, protecting long-term portfolio. Now the long-term portfolio, I didn't look at it yesterday. Oh, I did. I mentioned the number, though. Wait, I did. Hang on. I think it was 1345, and now we're at 1333. So these are working perfectly. The short-term portfolio gained 22, and the long-term portfolio lost 12. So we are positioned a bit bearish. Oh, that's weird. Look, SLW came back. How confusing. All right. So we were positioned. So we are positioned a bit bearish in that because as the market goes down, we're gaining more in the short-term portfolio than we're losing in the long-term portfolio. So that's all good. We're happy about that. That's the idea. The short-term portfolio protects the long-term portfolio. In the options opportunity portfolio, it's self-contained. It doesn't have a twin portfolio. So hopefully we're internally hedged. And let's take a look at that. That's at 186, except something weird because in this one, silver wheat is still not coming back. In this one, we're at 186. So 286, and yesterday in the OOP, see if it moved. OOP. Oops. Oh wait, in the OOP yesterday. No wait, I'm confused. There it is. I knew you looked at it. So yesterday we were 281. So we've actually gained $5,000 today in the options opportunity portfolio, even though, so in a bearish. So we're actually in both portfolios, we're leaning a bit bearish. That's what that tells us. And obviously you got to keep an eye on it. You can't just go by one day. But the gist of it is we're not being damaged by a downturn because we're balanced, because we have plenty of hedges, because we have the right mix of positions. And we were leaning a bit bearish as we topped out. And the main reason for that is because we cashed out a bunch of stuff. Last couple of weeks, the last couple of reviews we did, we cashed out some LTP positions and we cashed out OOP positions. We have a tremendous amount of cash, almost $200,000 in cash out of 286 here. So that's a lot of cash. That's a 66% cash here. And the LTP, I'd say, is close to 90% cash. So there's hardly anything to protect, really. Yeah, look at that. 1.1 million out of 1.33 million is cash. So that's really cashy. So what was the question? Tesla. Can we talk through it on the call? I still have the June 17, 300 calls, and I was thinking of rolling. Well, don't know if I'm in favor of that. Let's take a look. You see, you sold them for 15, didn't you? Where? You sold them for 15. So, and it's what, June? Oh, I know what I look in the portfolio for, so we can look and see what our Tesla position is. In the short-term portfolio, Tesla. We somehow ended up in the 320 put. I know, we only sold a couple and we rolled to like a 2X or something. Oh, no, I'm sorry, the 320 short call. So we had 3 and we rolled to 6. We had 3, so what we did is we had 3 short 300s and we rolled to 6 short 320s, which are now looking very good. They're very in the money. In fact, this thing's pretty profitable right now. I don't have any reason to think I should take it off, though, in this case. So your question is you still got the 300s, which are in the money, but even so, they're on track. I think this is a very realistic place to expect to end up at this blue 50-day moving average, possibly lower. But I'm a hater. I think I don't see the value to these guys. I really don't believe in this company. I don't want to say that. I like the company. I don't like the overblown bullshit promotional stuff that Elon Musk does. And because of the way he does it, it makes me think that these guys are right. That you're going to suddenly find out that this thing's worth half of where it is. Because the way they grow the company is by constantly moving the shells around. So they're not selling cars, and he opens up a factory to make batteries. Then the battery factory isn't going anywhere. There's no money coming in from that either. So then he buys Solar City. And then he announces these solar roofing things that are hellishly expensive. I mean, the cost of the roof is $60,000, $70,000 for the average home, which includes the solar tiles. And you can say it's competitive, but how many people in America can afford a $60,000 to $70,000 roof? Even with incentives and even with a plan, it's still going to be something. Unless if you're absolutely going to trade in your power bill and get the roof for free, that's fine. But Tesla is not offering that kind of financing right now. And again, this is a problem because he purposely confuses people, because Solar City was installing roofs for free. They would install your roof, and you would sign a 20-year contract that instead of paying your electric bill, you would pay the same amount as your electric bill to them, and in exchange for them solaring up your roof. You don't really save any money except for the anticipation that electricity always goes up. The funny thing about this is, though, that because people are starting to install solar panels on their roofs, the overall net cost of energy will go down. So for the power companies to compete, they may have to lower their prices. So the whole model that Solar City has, where they tell you that your electricity bill is always going to go higher, may not hold up. And as solar panels get more and more efficient, and the power companies start using solar panels instead of gas or coal or nuclear, their cost of running the plant goes down too, and they can compete effectively, providing you solar energy over the wires, over the electrical lines that they have now. They're doing it now. It's not a fantasy thing. There's plenty of power plants in America right this minute that are supplying solar-created energy. So what Solar City is trying to tell you is that you at home, on a small scale, will do a more efficient job of creating energy than a power plant that's able to do a large-scale production system. This is not true. It sounds wrong, and it is wrong. If you wait 5 years, 10 years, you will be getting cheaper power from the power plant. They'll have no choice because they'll have to be competitive with what you could do yourself. Before there was no option. There's no competition. You can't make your own electricity at home. Now you can. So when they have to compete with making your own electricity at home, and yes, some of these guys are going to go bankrupt, but the ones that survive will simply add solar systems. They won't buy coal anymore. They won't buy natural gas anymore. And it'll be a backup to their solar, though, so they'll constantly have power, and they will deliver it. And it won't be Elon Musk and Solar City that make all that money. It'll be the people who provide, like SunPower and people like that, who provide massive scale projects. Now, Solar City does try to get into that game, but there will be specialty guys and people like GE and Panasonic and so on and so forth. Those, the same guys who always do major industrial jobs will continue to do major industrial jobs. Just because Solar City also is a power company, a solar company, doesn't mean they automatically get their percentage of the business. It doesn't work like that. Panasonic can sign $1 billion deal and guarantee it with a bank with a line of credit that says they've got $1 billion cash in escrow against them not performing their contract. And the power company then can make plans to build a facility that costs them $5 billion around Panasonic's $1 billion installation that's guaranteed to be on time. You cannot, it doesn't matter what Solar City tells you, they can't make that kind of promise because they're not a global conglomerate that can guarantee every aspect of the deal being done correctly. So anyway, so Tesla's whole thing is built on a lot of bullshit that they tell people that is completely unproven. Even if it's true, you still would want, a normal person would want to see it proven. But the people buying this is not normal. But realistically also, I got to tell you, here's 2014, 260. Here we are in 2017, and we're at 309. This is not phenomenal growth. This is a freaking zigzag, up and down, wildcat company that happens to be at the top of the channel at the moment. And it will not surprise me one bit to see them at the bottom of the channel. And if they come down to 140, I might even start buying them. But at 309, it's ridiculous. Ridiculous prices, nothing to justify it. And yes, in the way they are running their company, they could blow the whole thing up. Because by trying to act like a great big company and constantly, pulling all these deals to try to make themselves look like they deserve to be $300, they're actually, they're taking on the debts of a company that's 3-4 times bigger than they are. And one little misstep and the whole thing topples like a house of cards. So it's a very dangerous company. Anyway, so you have the $300 calls. You sold them for $15. As long as the thing's under $315, you're okay. And if it's not okay, and they're June, so the June, it's not even Tesla. Okay, so you got the short June 300. They are now $16. You sold them for $15. See, you're freaking out about premium. You sold them for $15. They're at $15. If you don't like them, sell them. Get out of the position. But right now they're something I would consider selling as they are now. If you didn't like what happened to you when they went up, there's no guarantee that won't happen again. So get out. It's not a position you should be trading. If it makes you sick to be in it, get out. Don't trade it. It's not a stock for you. This is a stock that can go up and down $30 in 5 minutes. There's no way to tell which way it'll go. And by the way, if going up $30 is going to make you stop out at $40 with a huge loss, but going down $30, you'll only be up about 50% and you won't get out. Then you're basically you're playing Russian roulette, except you're basically saying, well, every time I miss, every time it's an empty chamber, I'm going to spin it again until I lose. Because that's what you're saying. You're saying whatever random gyrations it takes, I will stop myself out if it goes too high, but if it goes down, I won't stop out and take my profit. Well, then what the hell kind of trade is that? It's not a positive risk reward. If I want to make sure you understand this. Here it is at 16 now. So forget what you have, but it's at 16 now. So let's say Tesla goes up $20, back to 330. Then these will be about the price of the 280s, which is $27. You'll be $31. So you'll be down $15, okay? So you'll be down $15, and if they go the other way and it goes down to 280, then these will be like the price of the 320s. And they'll be $6, so you'll be up 10. So understand that during your ownership of the stock of the auction, the risk reward is against you. You're going to lose more when it goes against you than you're going to gain when it goes in your direction. And you don't make a play like this if you're not fully intending to ride it out until the premium expires. If that's not your intention, if it makes you nervous, if you have too much, not enough margin, if it bothers you to lose that much money, don't play this stock. Rolling doesn't help you. It's not about rolling. It's about an inappropriate position for your portfolio. These are risky bets. And 15 of them is a lot, by the way. I think you said you had 15. We have 3, or we have. What do we have? 6 now. We started with 3, and now we have 6. I would not. I wouldn't even go to 15 in this portfolio. I'd rather take a lot. It depends what you're playing with. If you have millions of dollars, then whatever. But the bottom line is though, but if you're not going to have the conviction to stay in the position, don't. And with it, and with our position, with 6. Short, if it goes to 350 and they're down $30 a piece, that's going to be $18,000. So I understand that. I understand this position can lose $18,000. I accept that fact. Okay, I understand that. If by going to 6, I know I can lose $18,000 if this thing moves against me. But I can make $8,000, and I think it's much more likely that I'm going to make $8,000 than lose 18. And even if I lose 18, by the way, if we lose 18, I would still roll the position and stick with it for as long as I could. because those 320 calls can be rolled up to the September 350s and the January 400. So what I'm really saying is I think there's no freaking way in hell that Tesla is going to be $400 in January. So let's take a look there. I'll tell you what it is. It's so I'm sorry. These 320s are now. I'm sorry. These 320s are now $7. But it's not about whether the 320s is $7. It's about looking down the road and seeing, well, who else is $7 now? So I get into January here, and I try to find something that's $7. Yeah, look, I'm up at the 430s. So in theory, I will be able to roll to September whatevers and then the January 430s. So my bet, having the short 320s, isn't so much that I think Tesla will be under 320. I mean, that is my bet. I think it'll be under 320 by June. But my confidence in the bet is based on the fact that I don't think there's any freaking way in hell that Tesla will be over $400 in January. So even if I get stuck and have to roll it, I will be happy to roll it out until somebody wakes up and smells the coffee on Tesla. That's what that roll's about. But if you're asking the question now, you're indicating to me that you're not that confident, that you're not comfortable to have it in your portfolio, and that you're thinking of stopping out or that it's causing a problem. And if that's the case, it's probably not a good position for you to be in at all. All right, so consider that. Now, question number 2. I know you're bullish into the holiday summer cycle. However, OPEC talk is failing. Inventory build is neutral, positive. Demand is blah, blah. Oh, we didn't look at the OPEC. That's a good thing. I mean, the OPEC. The Petroleum Status Report. PETROL. So their question there, I know, blah, blah, blah. So shorting should be considered. No, I'm not shorting until July because it's summer driving season. I don't understand. I don't care about the facts. The fundamentals do not matter between May and July. Okay, it's all about, are people driving or are people not driving. So it doesn't matter. I understand fundamentally. If the fundamentals were all that mattered, oil would be $35 right now. That's not the case, though. If you think about it, a good part of the premium of oil is based on the fact that there is a possibility. See, the reason you buy futures contracts in oil is because you're concerned about you're not really concerned about a sudden surge in demand. That's not a realistic thing to happen, right? Between now and the end of 2017, it's not likely that world oil demand is going to go up 2 or 3%. It doesn't work that way, okay? It's just, and frankly, because of efficiencies, it's going down. But, the population isn't growing that much, business isn't growing that much. You can tell how much oil you're going to need from year to year. It's not that complicated. If you look back at 50-year history, you can see a very steady, slow growth of demand. Sometimes a little glitch here and there, but very rarely does it go off the charts. So you're not buying oil futures to lock in against a surge in demand. You're buying oil futures to lock in against a interruption of supply like the one we had in 1973 and never again. I've never had one again. But because of things like that, and it goes with any commodity, any demand commodities like that, because of that, there's a premium built into it based on the fact that it's possible that something could happen to supply and that you would not be able to get oil. And if you can't get oil and demand stays steady, which is not necessarily the same thing. So like take 9/11, for example. 9/11, everything ground to a halt, but because everything ground to a halt, oil prices went lower, not higher, because even though they weren't shipping oil and everything got interrupted, like the whole world basically stopped for a week. Even though the oil wasn't shipping, nobody was going anywhere or doing anything, so it didn't matter. There was less demand. So in the end, it depressed business activity and oil went down. It's a good thing, too, because if it had worked, we'd probably have a lot more 9/11. Meanwhile, you have to look at the bigger picture and what's going on. So because OPEC, because the only reason that we're in a supply-demand balance-ish, balance kind of, the only reason you have a balance of any kind is because they've taken 1.5 million barrels a day offline. But that means that at any given time, they can put 1.5 million more barrels on the market. Now, they've always had the ability to put 1 million or so barrels on the market anyway. So right now, they have excess capacity of a couple of million, maybe 3 million barrels a day could be dropped on the market at a moment's notice. So there shouldn't be any risk premium. There's no logic to locking in long-term oil. And when you look at the long-term charts, you can see that there's nothing. There's no rising prices. The contracts are flat for like 10 or 20 years out. So where's that report? Now we had some weird numbers today when we were looking at the summary. So we're going to take a look at this and see what it looks like. All right. So the interesting thing is we have a net build of 3.6. See 24.2 to 27.8. There's a net build of 3.6 million barrels. And look where it is. Wow, look at that. See this? All other oils went from 23.1 to 31.4. So again, this is what they use when they want to fake demand. They use it as a swing item because it's not reported. When you get the reports from the EIA and the API, it talks about oil and gasoline and distillates. It does not talk about all other oils. So if the refineries want to create the appearance, or they want to create the appearance of demand, what they do is they say, okay, we have to use oil, otherwise it looks like we're not using any, and then it builds up on the other end. So we're going to use oil, but we're going to use it to make stuff that doesn't show up on an inventory report. All right, and why does the refinery do that? They do that because it makes it look like the gasoline was in demand, because all people see is that gasoline went down. And they say, look, we used the oil barrels, and the distillates went down, and the gasoline went down. Therefore, there must be demand, right? Anybody who doesn't take a close look at this is going to come to that conclusion. If we used up oil barrels, and the gasoline went down, and the oil went down, there must be a big surge in demand, right? But when you think about it, again, it goes back to how unrealistic is that? It's not a small sample of people that we have. We have 200 million people driving around in cars and all the factories and everything else in this country. Why would the demand for oil swing by more than a couple of percent in any given month? And a couple of percent when we're producing, we have 17 million barrels of oil a day that we're using. Times 7 is 49, 120 million barrels. So we use about 120 million barrels a week. Why would that be up and down more than 2 million barrels on any given week? There is no reason. How is demand going to suddenly go? Let's say a driving week. In fact, we just did the math on that. And even on a driving week, you're only using a few million extra barrels tops with all the cars going on the road in a driving weekend. Other than something big like that for some reason a lot of people hit the streets, in any given regular week, you're not going to have much swing. So most of the swing is simply caused by choices that these guys make. Like they're exporting 2.5 million barrels a day out of the country. That's how much extra oil we have. They're shipping out 2.5 million. That's 17.5 million. An entire day's supply of oil is being shipped out of the country every single week. Once a week, 1 day's supply out of the country. That's how much extra oil we have. That we're refining it here and we're shipping it out as petroleum products. And while we're doing that, we're building up this all other oils by 7 million barrels, by 8 million barrels. It was just ridiculous. Anyway, so fundamentally, there's way too much oil. We're not using that much of it. Demand is down. It's not coming back. They've got some serious problems. But meanwhile, the prices, oddly enough, are the same as they were last summer, and gasoline is the same as it was last summer. So we're certainly not catching a break from any of this stuff. Actually, gasoline is more expensive right now. And why is that? Because it's manipulated. That's all. And this is how they manipulate it. They pretend there's demand by the refinery choosing to make more all other oils. They make it look like people are using a lot of gasoline and a lot of diesel and distillates and whatever. And by doing that, they can keep these prices up. And these numbers are worth millions and hundreds of millions of dollars to them. Having this number be 36 instead of 24 is worth probably $1 billion to the refining industry. So they're motivated. They're highly motivated. And so what do? They make other oils. They make things that take away from the oil and gasoline in their refinery. They ship stuff out of the country, and they keep the prices as high as they can, no matter how low demand gets. No matter how much, this is the bullshit of the whole thing. No matter how good of a saver you are, and this is all because the Republican Congress undid everything that Obama was trying to accomplish. Because what they're doing is they allowed them to ramp up the exports. I mean, look at they doubled the exports from last year. They used to not be allowed to do this. Now they're allowed to do this. So it totally wipes out all the savings that we've done. So in other words, all the economizing and all the buying the smaller car and getting the better engine and getting the better mileage, it's all wiped out because they're taking all the oil we've saved and they're shipping it to other countries. Complete nonsense. So that's what's going on. Anyway, so fundamentally, yes, there's no reason for oil to go higher, but it doesn't matter because because fundamentally they manipulate the crap out of it. And you can't stop that. And why should you? Don't worry about it. Just trade with the traders. Do what the trade's going to do. So oil will go up until July 4th or maybe into, sometime in June it should top out. So I've only got one long. By the way, that being said, I've only got one long. So where is oil? Oh, look at that VIX. That's so funny. Man, we're going to start having some fun if we get a better VIX. So much better for options. Oh, I don't have to. Oh, remember last week we switched to the new contract, CLN7. We don't trade this one anymore. And right where it was last week, I'm down $30 for a week. It's the same one contract. Because we only went down to what, 47.50 was the low? Yeah, here, 47.75 was the low, and I didn't think that was good enough to double down on. Where was this? Where's that? 10. Oh yeah, that was last week. Okay. So last week, remember we rolled over the contract, and I kept one. We took the money. We had this top, and we took that money and ran. And I kept on one contract at this line, and I wanted to get more, but it never really got cheap enough for me to want to get more. So I'm just still got the one contract right now. Hopefully, the contracts that are out now, the M7 contracts, the Junes, are going to expire on Monday. I'm hoping between now and Monday there'll be one more nice, real good sell-off, and then I'll probably go up to 4 or 5 contracts long. But a real nice sell-off for me has got to be at least 47.50 or lower than 47.50. I'd like to see that. If that doesn't happen by Monday, then I'm still going to add another contract either way. I still want to have 2 long, at least into the holiday. But it's a tough trade because, again, the fundamentals are going in the complete opposite direction. There's no reason why it to be this expensive. But on the other hand, it always goes up into July. So why would I not want to take that trade? Oh, look, the date change on coffee. There goes all my money. So my P&L for the day is now 187 because the contract stopped. All right, so these indexes are looking bad. Bad, weak bounce, and failing. These are going to go lower, guys. The market's going to sell off more. And of course it is, because nothing's resolved. What got resolved today? Everybody's screaming and calling names and pointing fingers. That's not a fix. The CBI 2019-20 yes, of course I like those, definitely. Oh, and don't forget, OPEC's got a meeting like the 24th, a Thursday. What's a Thursday? Nope, 25th. All right, so next week on the 25th is an OPEC meeting too, and they're gonna announce the same bullshit. I think at this point though, I think OPEC's got to announce a bigger cut. I think they're not going to, because to them, what's the difference? Because they're not going to do it anyway. But they'll say another 500,000 barrels, and that'll pop us back over 50. So we'll see them right next Wednesday. But we won't see. But I think next Thursday, with the holidays this weekend here, next Thursday they're going to say that they are going to increase their production cut. And the Saudis will do it even if nobody else does it, because all they can do is drop 500,000 barrels. They're going to increase their production cut to by 500,000 barrels. I think that'll bring them up to 2 million a day. All of a sudden, everyone's going to go, "Oh my God, that's going to drain our excess so fast." Blah blah blah, and that'll give them an excuse to pop oil higher, which they absolutely everybody in the energy pits wants oil over 50 into this weekend, so they can get gas. They can get gas up another 20 cents or whatever to be. Gas will be like. I don't know what it is. What is it? $3.50, $2.50. So gas will be at least $2.50 instead of $2.36 right now. And it's just a screw job. All they're doing is screwing the American public and stealing money from them. That's all. But they do it every year because they can. Carnival Barker, borderline crook. Who are we talking about? Did I miss something? Okay. Anyway, I could probably describe that whole trading pit. A lecture on GE, please. GE is a great company. Come on. I'm going to sit there and do a whole presentation on GE. GE is a giant conglomerate. I haven't liked them since they gave up their financial units. I thought their financial units were very strong. And frankly, look how they perform. Having the in-house financials and having that gigantic real estate division, I always thought it was a good thing. I disagree with their decision to spin those off. I like them down here as a long-term buy. I mean, they're only $240 billion, but look at the numbers. You've got to look at what they make. Nothing. No, there it is, $10 billion. So this was an aberration. Pay no attention. They make $10 billion a year. 120 billion in sales. I mean, it's going to go up and down, whatever. It doesn't matter. $10 billion. Okay, so if they're trading at 239, they've got a PE of about 24. It's fairly priced. It's not cheap. It's fairly priced at this number because they spun off those frickin' divisions. They used to make more money. They have more cash. Because they sold stuff off, but I don't care if they have cash. I want them to make money. So they have $48 billion in cash, $44 billion in investments, forget the receivables, forget the inventory. So they have $90 billion in cash in America. Not many companies have cash in America. They got $90 billion sitting around. But are they doing anything with it? No. And by the way, it's very, very telling, though. When you've got companies like GE sitting on $90 billion, and they look out at the market, they say, there's nothing to buy. Then you know things are overpriced. I don't understand how people think the market is fairly valued when companies are sitting on $2.5 trillion in cash, either in the U.S. or overseas, and they're not acquiring anybody. Why would that be? What possible reason would you have not? Warren Buffett's not buying anybody. He's buying some stocks because he's got to do something. You don't want to not do anything. You look stupid. You got to do something. So he moves some stuff around. He gets rid of some IBM. He buys some Apple. There's not much you can do. And again, if I had $50 billion to move around like Warren Buffett does, I'd be buying Apple too, because there's not too many companies on the planet Earth I would put $50 billion into. Because they're ridiculously priced. Because this is unrealistic. GE is It's not unrealistic. But 24 times earnings for GE is a lot of money. They're not going to double. When you pay, stocks are not risk-free. So when you're paying 20 times earnings, you're getting effectively a 5% return on your investment. You're going to get your money back. Not a 5% return, I'm sorry. Yeah. They're earning 5% of what you give them. So the theory is that they're going to earn, for every 20 you give them, they're going to earn $1 every year for the next 20 years, and you'll have your 20 back, and then you'll still have the stock, and hopefully the stock will still be worth 27, and you'll be ahead. You'll have doubled your money. But what the frick is that? Doubling your money in 20 years? That's what you're investing in this company for? And then you say, oh, no, I expect the stock price to appreciate. So now let's think about that. How's the stock price going to appreciate? Because the next guy to buy it has to be willing to wait 30 years to get his money back. And the guy after that has to be willing to wait 40 years to get his money back. At what point do people sober up? That's why I know I say no a lot, but people ask me about companies. I'm like, no, I don't like companies that take more than 20 years to pay me back. It's already, unless they're growing, I don't even want a company that takes 20 years to pay me back. I want 10 years. I want Apple. Apple takes 12 years, 11 years to pay me back, but that's not even including the fact that they've got half the money I give them is sitting in cash in their wallet. And they're growing. That's the company I invest in. So I have to benchmark the things I buy against, or I have to benchmark things I'm going to buy, saying, or I could buy Apple. Now, you want to be diverse. I don't want to buy only Apple, but I do want Apple to be like 20% of my portfolio if it's the best company like that. You've got to buy the best. You can't not buy it. That's what Warren Buffett finally did this year. He's like, I got to buy Apple. And then after holding it for a year, he bought more Apple. You've got to buy stocks that are worth buying. GE is not a bargain just because they got cheap. And they're not a bargain because they went down for good reason. They're not the same company they were. They sold off their divisions. They traded their profitability for cash. So you say, okay, they got $90 billion in the bank. Okay, well, you have to. Now, Apple has $250 billion in the bank. That's 1/3 of their market cap. GE's got $90 billion in the bank. That's 40% of their market cap is in cash. That's what makes them a reasonable thing to have. But they can't think of it. It's sitting in the freaking bank. They have short-term investments. But generally, sitting in the bank, short-term investments generally means like short-term bonds and things. Not a short-term investment is not that they put their money into some company, right? The short-term investment is bonds or notes. And again, not that, but that's the problem. Notes pay so pathetically. Where's the balance sheet? Notes pay so badly. They got more money in cash than they do in notes. Because it's not even worth it. What are you going to get? 1%? It's not even worth the hassle of having them. Apple's problem is this is how much money they make every year. You run out of things to do with it. What do you do with the money if you're not unless you're willing to buy stupid stuff? What do you do when you're dropping $50 billion to the bottom line year after year? You run out of things to buy. So anyway, for GE, so because of the cash, I like them. But business-wise, I don't like them. That's the problem. Their business itself, I wouldn't pay the money for. If they didn't have the cash, I wouldn't even consider it. And again, they have the cash, but they have no idea what to do with it. Because where is GE going to find another company? All right, let's take out the cash, and let's say that they are an $18 stock. And they're making, here you go, they're making $1.50 a share. So their PE is practically 10, like Apple. If you take out the cash. But I'm willing to say that. I'm willing to say, let's take out the cash and call them a PE of 10. But the problem is, what do they do with their cash that won't negatively impact their PE? Because if the base operation is a PE of 10 and they got $90 billion in cash, what are they going to do with the $90 billion in cash? They can't buy a company that has a PE of 10. There are none anymore. That's why they're sitting on the cash. Anything they buy is going to have a worse PE than they have, and it's going to negatively impact their overall earnings. And GE is so big that there's really not a strategic investment for them to make now. They should probably buy Chicago Bridge and Iron. But you can't buy Chicago Bridge and Iron, right? Because CBI, we go compare that. Where's this one? Wait. There we go. So CBI makes $10 billion. They drop nothing. But let's say in a good year they'll drop $500 million to the bottom line. That's a PE of 20. So if GE buys them for how much? If GE buys them for $2 billion. That's actually not so bad. If GE buys them for $2 billion, and they're going to drop 500 to the bottom line, that's a good buy for GE. But this isn't steady. So GE would have to look at this and say, okay, let's call it maybe $250 a year. All right, so now they're saying $250. So now the PE is around 10. But the problem is if GE buys them, they're going to have to pay more than $2 billion for them. They're going to have to pay $3 billion for them, and now it's not as good as GE is. So, the companies like GE and Apple that have a ton of cash, there's nobody for them to buy other than each other. And everybody makes up this bullshit like, like Apple will buy Tesla. Apple's not going to buy Tesla. For $50 billion, you don't think Apple can build a freaking car if they want to? Elon Musk just did it. He's not smarter than the guys at Apple. Elon Musk just built the car. Apple could buy Ford, or actually Apple could buy Fiat for half the price of $20 billion. They've already got tons of business, and they can tell them to start making electric cars. That's why these valuations are just completely insane all over the place. Anyway, so let's go what topic that was, but whatever. Oh yeah, futures. I forgot about that. We didn't talk about that. All right, so they had a whole lecture on GE that I wasn't going to do. Do you think KC at 135? No, I don't short things I like long. I don't flip-flop on my things. It's like I like coffee long, so when it gets cheap, I like to go long. When it gets high in the channel, like 135, I take my profits. When it goes low again, I buy some more. I do not short. I don't short something when I think it's going up. I don't go long on something when I think it's going down. I don't understand how people even play like that. How do you even know what position you want? What happens when it goes against you? I mean, don't forget the whole point of the way I trade these things is that when something goes against me, I add more. But if you're flip-flopping on a line and you're just randomly short and long on something, then what happens when it goes against you? What does even against you mean? And what do you do about it? If you don't have an investing premise, I don't understand how people even play stuff. I understand probably most of the people I'm talking to are chart people. But seriously, I can't even imagine how you sit there without an investing premise playing futures. It's like madness. It's just like completely, you may as well play roulette. RB, no thank you, too crazy. Everything's too crazy right now in that thing. Just like I said, I have my one oil contract. I mean, how much more can I tell you guys than that? I have one oil contract. That's it. I just sold almost all my coffee. I have no outstanding futures. This is a very crazy moment right now. Can you review the Amazon change you described in the STP review? I guess I could if I can find it. And GE bought Baker Hughes, did they? They bought some of, they didn't buy the whole company. They bought, wait, I'm confused. GE by Baker Hughes? As it maybe looks. Well, they bought assets. Oh, it's a whole merger. I didn't even realize that. I thought they were just buying assets. Oh, I see. Oh, no, I see. It's GE's oil and gas business is being merged into Baker Hughes. That's why that's backwards. So no, GE is not buying Baker Hughes. GE is forming a company where they're spinning off their oil and gas stuff with Baker Hughes to form a bigger Baker Hughes or whatever they end up calling it. But it's not like GE is buying Baker Hughes outright. But we'll see. We'll see if whether it keeps going forward or whatever. It probably will, though. If GE's doing it, they wouldn't be wasting their time. All right. So anyway, so looking at the futures, I have no like I said, I'm skin in the game right now. We're down nicely now. 1.25. So here you go. Now the Russell is down 2.25%. These guys are down 1.2%, 1.2%, and he's down 1.6%. So the Russell's down more than the others. It just bounced off 1,360. And now these guys look bouncy. So if I was going to play, I'll take the Russell. He's lagging. So just for fun, and this is just a technical trade, you sit there and I take the Russell and I say, okay, I'll buy one here at 1362. Nope. Not going to buy it if it's going down. Only buy it if it's going up. All right. Now I'll buy it. Oh, and now it won't fill. Bastard. There it goes. Okay. And of course it goes down. All right, so now if I'm going to watch the Russell, what's going to be affecting the Russell? I'm going to watch the dollar. I'm going to watch the S&P. Yes. And I'm going to watch the Dow. I'm not even going to bother looking at the NASDAQ because that's a stupid index. Although, what's Apple doing? AAPL. Apple's at 151. Okay, so Apple's also, he's doing the second bounce off the year. That's good for the NASDAQ too. But let's watch the Dow and see what they're doing. All right. So hopefully we can make a few bucks off of this. I'm just playing for the bounce. So I'm watching these guys, and if they stop bouncing, I'm out. So we watch. Now I'm watching the 2370 line. Oh, by the way, the dollar's not moving. I do like the dollar long here. Hey, let's do that. We haven't done that. Buy a dollar future. All right, we'll just put that away for next week. That's just under 97.50. So next week we'll see how that one does. So I don't have conviction on this at all. I'm basically saying these guys look like they're bouncing. If they pop over these lines, if he pops over this line, 20,700, and if he pops over 2370, then I will have a little bit more faith in this thing going higher. But it does, of course, it goes the opposite direction then. So we're going to watch them both and see. But that just seemed like something possibly to make a bounce play. But if it doesn't, I don't have conviction. I'm going to get out pretty quickly if this thing's falling apart. And they are. Everybody's heading down. It's barely a bounce. And again, the problem is we had no reason to do it other than somebody asked and said, let's play a future. So I'm showing you a quick way to play it. But already that quick way to play it's cost me $50. See, as it looks right now, it looks like it's getting weaker, so I'd rather take the loss. Done. And I'm down $55. No, $35. Sorry, $35. So that turned out not to be a good entry. The bounce was a false reading. What you really have to do, though, before trading, and I do this all the time. I mean, the webinars are a bad example because I don't do what you should do. And what you should do is it should be only because the news tells you to get wrong. So you can go to, like, Seeking Alpha. See, when I see something in the news that makes me want to go long, that's when I like to go long, not just for no reason. NASDAQ's down 112 points. Wow. So while we've been talking, what has happened that's been giving us reason to do anything? The VIX is way up, we know that. Southwest, who cares? European advisory, reject AB science, don't care. Prison stocks. Oh no. Oh, we're not going to be putting people in prison like we want to. How terrible. Google kicks off I.O. with $2 billion. What? Ooh, Google's got 2 billion Android devices out there. Very good. Not keeping them positive though. Southwest allocation, California Judge approves. Oh, there you go. There's Volkswagen Southern, but that's good for them today. Baird upgrade Wolverine, United Health. Look at this. United Health got busted for $1 billion of overcharging Medicare, and they go up. Unbelievable. Walmart. So Walmart is holding up into earnings. Target had good earnings. There's no reason to think Walmart shouldn't have it. Rio Tinto's cheap healthcare. There's nothing here. There's nothing here that's changing the market since we started our thing. We're already back to 12 o'clock. Industrials plunge on concerns of the Trump agenda, blah, blah, blah. Obviously, see, everybody thinks this whole thing's falling apart in the White House. And unless that changes, and what's going to give you hope for that? So I'm back to my earlier thought, which is that we're actually going down, and we're not even bouncing. And that wasn't even a tiny bounce that we had there before. I thought we'd at least have a bit of a bounce, but we didn't. And then, so the dollar I like here, though. I think why it's going to affect the dollar in the long run. I don't see that. And don't forget, if people start selling these stocks, it created demand for dollars. Oh, you want to see something funny? I bet you look at the Wall Street Journal. It's always a good place to look when you want to see what's going on internally. Market data. See, and this is a good thing to look at. So, 700 in the NYSE, 700 advances, 2,300 declines. So that's like three something more times stocks decline than advancing. But look at the volume. Advancing volume, not even 5, and declining volume is about 2 billion. So you're looking at like 4-to-1 declining in volume. And that's a big amount. And if we go back to Yahoo now, and we go to SPY, we'll see if in general it's a big volume day. So I like SPY is the easiest way to look. Go to historical data, and then you see what the volume is. And the volume is not that big. I mean, it is big because it's not, it's only 2 o'clock. But 89 now, figure in 2 more hours. Usually the last hour is about a third of the day. So figure will be at 100 million by 3 o'clock, and then another 30. So we see about 140. So yeah, it's a pretty good number. 140 compared to 50 yesterday, as we made our all-time highs, right, on 50 million trades. It's hard to even see because frequency. Let's do weekly. Watch, show you. Weekly, you should go to see that. How far back is it going? It's not going far back. Oh, because the range doesn't change. Monthly. Why? I'm going to make a bigger range. Start date. 14. Done. Okay. So, going back to 2014, and by the way, things have been down for a lot longer than that, but 2 billion, I think it was a billion. Yeah, billion. 2 billion, 2 billion, 2 billion. 4 billion, 1.5, 3 billion, 3 billion, 2 billion, 2.7, 2. Now we get to this year, and we're like 1.4, 1.3, 2 billion. So 2 billion is now a big month. It used to be 3 point something. So back here, a few years ago, 3 billion was a big month, and 2 billion was a normal month. Now 2 billion is a big month, and we're in the 1.3, 1.4 per month. So it's really sad stuff. Even last year, 3.7, 2.9, and 2.3 in the first quarter. Here in the first quarter, 1.4. That's half the trading volume. This is 2.9 went to 1.3. When I talk about low volume, I'm talking about insanely low volume. We're down 50% trading volume from last year. So it perked up a little bit in March, But then April, which is over, 1.9, and it's 1.5 here. And May we're halfway through, so May's a little low too, because May was 1.8 and whatever. So as you can see, these numbers were lower than the prior years. And then now this year, though, we've been trading the first quarter, especially this big rally we've had has been on one half the volume that we had last year. That's a very, very weak rally. It means there's very little actual support. So not that much money came into the market to support where the prices are. And that's why it's so dangerous. That's why it's so easy to have a great big sell-off. So this thing is not, it does not have the appearance of something that's going to stop very easily on the way down. I think we're pausing. Oh yeah, glad I got out. See, now we even failed 1360. So I would not make any big bets here at all. I mean, you know, the 2.5% line is going to be hit soon. 2.5% line is going to be, oh gosh, number 3, maybe around here at 1356. That's going to be the 2.5% line. If that fails, this thing's in big trouble. And here's 1.25%. We know 1.25% is important. So we're failing 1.25% here. If we fail 2.5% here, that means that you can start shorting the dollar, not the dollar. There's NASDAQ. NQ, they're probably down too. No, the NASDAQ's down 1.7%. So everybody's failing their line. It's not pretty. So Team Trump's got a lot of work to do to restore people's confidence, because right now it looks like we're going to leg down below this. And that's a hell of a hit. I mean, you got the Russell down 2.5% in a single day. That is a nasty, nasty hit for an index to take. Now, if we were normalizing, we'd be looking for a half a point bounce. So here we are right now at 1359. Actually, 1359 turns out to be the 2.5% line. So coming down from here at 1390, so it's about a 40-point drop for the day, and that means we'd be looking for a bounce to 1370, about to here. So we'd be looking for a bounce to there as a strong bounce. Unless we hit that line, which I'll tell you right now, it's not looking like it's going to happen. Unless we hit that line, we're probably going to actually leg lower at least another 20-point drop tomorrow. So if we don't turn around now, and we're not going to, this is a fail, I can tell now. Let me get my money back, in fact. No, forget it. All right, so now I'm short at 1358.40. I'm going to get my $35 back. Because I'm telling you, this looks like it's going to really go down. But of course, it's going the other way. And what you want to watch now is how easily does it cross back over. So if these guys get back over their 1.25 line, and if they do, then there's hope. But I think it just bounced from over. Oh, there it goes, right back into the thing here. So I think basically the fact that I shorted it caused it to bounce up. Other than that, there's no reason to bounce up just then. But this is bad. I mean, this is a very, very ugly sort of market right now. And it looks to me like it's, you know, these lines are failing, and people are going to start panicking. If these lines don't hold up, see this bottom here, and this bottom already failed. This one failed, this one failed, and this one failed. These guys are all failing. And there's my money back. You know, I want to get my money back. We have plenty of hedges, so I don't need more of this. Come on, a little lower. Be greedy for $5. The S&P, whenever you're playing another future, you want to watch the S&P because they've got the best lines. You know, the S&P will have some kind of support almost every single dollar unit along the way down. So when you see the S&P break to the next level, that's bad for everybody. So right now it's holding that 64 line. Still don't get the bid and ask on mine. So weird. You know, they seem to be holding it. Oh, now I lost 50. So like I said, not the best time to trade these things. But I don't know. It looks pretty damn weak to me. All right, so I'm going to leave that for a minute and see what happens. I got a feeling it's going to go lower. Oh, Amazon changed described in short-term portfolio review. What? I don't know what that was. What Amazon change? There's no change. Not the hedges. Okay. This one be easy to say. If the September 1,000 calls are $40, we could do, not that we are doing, we could do a 2x roll, and then we started the trade with a net credit. So until then, there's no reason to do anything, though. We have the Amazon, we're short 2 July 900. We sold them for $50. Amazon's at $967. We're down $17. And it's June. It's July. It's not even June. It's July. So there's nothing to do except for wait and see what happens. And again, this goes back to what I was saying before about the other one. These are risky trades. They're going to go up and down significantly. This is a $500,000 portfolio. You don't see me putting this in the options opportunity portfolio. It's a $500,000 portfolio. It doesn't matter if it goes up and down $20,000. It's not important. It doesn't affect any. It won't affect in any way, shape, or form anything that we're looking to buy or do anything with or move or change. It's impossible for this position to hurt us. And it's, I don't mean you can't lose $20,000, but losing $20,000 in a $500,000 portfolio is really not that big of a deal. So it's a position that we intend to leave on and take advantage of the decay in the premium. You don't do that if you change it every time it moves against you. What we do, though, is we sold these May puts are going to expire worthless. And, well, we had a spread, actually. So these 920 puts are going to expire worthless. So this spread's going to expire worthless. We need these to expire worthless to make money because we spent $4,000 here and we collected 10 here. So we have net $6,000 in our pocket from this spread. There's only 2. So any loss that we take, in fact, even where we are now, our net loss is not that bad. But if we can get these guys to expire worthless, because these guys are up $8,000. If we can get these to expire worthless, then we'll be ahead. That's all there is to it. So all we need to do is wait until these expire worthless, and we do that by waiting. You don't do that by moving your position every time Amazon moves. You do it by waiting. And so all I was saying here about the Amazon is if the September $1,000 calls are $40, we can roll there, and then we'll probably sell some more puts too. But that's an if and a when. Currently, let's take a look where we are now. Oh yeah, I got my money back. All right, mission accomplished. Oh, there it goes. I am now up $50. Yay! And that's how you trade the futures. Meanwhile, down we go. Look at that. See, I told you it was going to break down. Wow. This is some ugly crap, guys. There's a lot of, there's such a thinly traded market, and this is going to trigger all sorts of technical issues. And if these computer programs and these ETFs start selling and there's no buyers, we can drop like a rock. So I hope you guys have good hedges, because we've been preaching hedges for God knows how long. I hope everybody's got them. What were we just talking about? Amazon. Oh, yeah, let's look up Amazon. So I said, if the September puts the, not put, short calls, A, N. It's the same thing I was talking about with the Tesla stock, okay? I don't see Amazon breaking over 1,000. But I don't think, I'm just saying, if I have to roll this, September 1,000 calls are currently just under $40, they're $35. Meanwhile, the short, whatever we have, what do we have? We have the short July 900. June, July. So our July 900s are, they're only $68. So if the September 1000 are $35, that means that so two of those is 70. So I can easily do a 2 times roll, and I gain $100 in strike. And then if we look up to January, and I look to see who is $35 in January, that's going to be the 1080s. So basically, every quarter I can rise another $100. $100. So in other words, that means in a year I can roll Amazon up 40%. So the play I have in place right now is basically saying I don't think Amazon is going to make 40% a year for the next 2 years. I think they'll get tired before my rolls get tired. And that's what I believe. So since I believe that, I'm perfectly comfortable leaving the position on and let it take its course. I'm not changing it just because it's currently going against me. I haven't changed my mind about Amazon. It just currently went against us. Big deal. Okay, hopefully it'll turn back in our favor. If it doesn't turn back in our favor, then we're going to roll it when it's close to expiration and there's no premium in it. But again, it goes back to if you get into a position, the first thing before you even begin buying anything, what are you going to do when it goes 20% against you? And if you can't figure that out, if you don't have a plan that you like, not that you hate, if you don't say if it goes 20% against me, I don't care because I'll do this. And if you can't say that, don't get in the position. Bad position. Because just in complete random statistics, a third at least, probably half of your positions will go 20% against you at some point. Doesn't mean you're wrong, it just means they went against you. If you're holding a long-term position, and look at any chart you want, look at, well, in fact, let's look at Amazon. Tesla obviously goes up and down like crazy, which whether you're long or short, they went 20% against you. Doesn't matter which one you were. Amazon, basically, well, if you're short, they certainly go 20% against you a lot, but here's 580 to 450, it's $130, 20% against you, even if you were long. Then up and now down, 20% against you. And here, up, 20% against you. Whether you're long or short, even Amazon, which Warren Buffett is now calling great. Although Warren Buffett doesn't own it, he says he likes the company. He likes Bezos now. So Warren Buffett likes it because he likes them, but he wouldn't buy it. It's freaking expensive. But even a company that's given the best returns on the S&P for the last 20 years still goes 20% the other way every once in a while. So what's my logic? My logic is I say, hey, now this is half, so let's say there's a $50 roll, okay? So I get into Amazon at $450, and I sell the $500 call for this quarter. And I say, okay, I don't think Amazon's going to go up $50 next quarter, and I'm going to collect $25 for selling the $50 calls. I'm cutting everything in half from what we actually did. So I don't think they're going to make it to 500. I'm going to sell the $25 call for 500. Well, let's say it was a 475 call that I sold for $25. And I'm saying I think we'll come back. I think we'll stay under 475. So what happens? I get totally burned by $100, and it hits 480. It hits 580 before the quarter expires. Now, so I've got a big giant loss here. I'm negative 100 on these, and I sold them for 25. What do? I roll them up $50. So I go from 500 to 550 for the next 3 months. So it's August, September, October, November. So now I'm at 550 for the next 3 months. And son of a bitch, they do it again, and they burn me again. And now I'm burned by $125. And I say, well, that sucks, but I'm just going to roll it again. So now 1 month, 2 months, 3 months, and now I'm at $600. And what happens in my third month here? They fall, and it expires worthless. So I had to do 2 rolls of $50 each, and then I finally hit a point in which I got my break. Then we start the cycle again over here. So then I do it again. So then I say, okay, I like playing it here. So I say 600. So now I'm going to sell, or let's say it fell down to here. So I wouldn't do that though. Having just gone through that, I wouldn't do it. But let's say it gets back to 600, and I short it again. So now at 600, I short the 600 calls for $30. So we do that here, and we do it 1, 2, 3 months out, and we get burned. Then we go to 3 months and $50. 1, 2, 3. Burned again. 3 months again. 1, 2, 3. Almost even, but not quite. And then we're going to go 1, 2, 3. Again, not making any progress. Oh, by the way, I'm sorry though. Because it didn't burn, because the gap didn't change though, I'm only rolling out. I don't have to roll double down because it didn't burn me by enough to make me double. I'm only just rolling for the next row. And so here I go 1, 2, 3, and then we go 1, 2, 3. So after 6 rolls, I'm at $900 on the same amount of short options. Because every 3 months I get to roll up $50. And in fact, now, as we just saw, I could roll, if I wanted to double down, I could roll $100 up. So my plan, but again, I don't just randomly do it. I do it when they seem really toppy. And I thought that 850 was really toppy when we started the spread. And so when they're getting up here, and I think 1,000 is absolutely going to cause a pullback. If 1,000 doesn't trigger a pullback, I don't know what will. So we'll find out. But meanwhile, I'm not worried because I can roll from 900 to 1,000, from 1,000 to 11, from 11 to 12. They just don't climb that fast. This company is not going to devour the planet Earth, and that's what it would take to keep appreciating like that. All right, let's see. Where do you think the dollar will bounce? I think the dollar should be about I think it should be right about 100. I mean, about 100 is fair for the dollar. It's really about the euro right now, and obviously we look like idiots. We look like an insane country. So it weakens the currency, but it'll calm down. Even if we, in fact, if we impeach Trump, it will calm down fast because that's the thing. The fact that we're letting this guy run our country is what's freaking everybody out around the world. Where do you see Apple headed if it falls? Oh, well, if they fall, well, they are going to fall. They're going to go down with the rest of the S&P. Oof, look at that. That's ugly enough, right? $5 looks terrible on that chart. It's really not a big deal, though. See, even Apple, even the greatest company on the planet Earth, pulls back once in a while. Not lately, though. Jesus, look at that run. Woo! So, but again, it's so stupid. It's like they've had a 50% run since September. 50%. So I think they'll pull back here. I think 125 is a fair pullback and a good pullback. I think they can easily justify 130. I think 130 should be the base. Yeah, I mean, this company's worth $180. There's no question about it. It's just a question of how long it takes them to get there. Like I said, they got about $300 billion in cash at this point, and their market cap is only $700 billion. So 3/7 is some big number. So maybe they're over 40% in cash. So their valuation, the value of this company is ridiculously low. And again, we're waiting. A lot of these companies are very disappointed that they haven't been told they can repatriate their cash yet. But even if Apple repatriates their cash, they're just going to look like GE. They're going to have a bunch of cash sitting on their balance sheet, and they got nothing to do with it. So it's a funny thing because it makes the cash less valuable than you think. Because if you can't figure out what to do with your cash to make money, then what good is it? I mean, for me, I would rather that they have a $5 billion new iPhone making machine, than $5 billion in cash, because the $5 billion iPhone making machine is going to make them $1 billion, $2 billion a year going forward. That's 20% back on the $5 billion cash. I don't want them to have $5 billion cash. What good does that do me? They can give it back to me, but that only lessens the stock price, because then they don't have $5 billion in cash anymore. So they gave it to me. So returning cash to the shareholders doesn't help. It's like dividends are bullshit. Because dividends is just taking your profit and giving it back to the shareholders. And now I got to figure out something else to do with it. It's like, no, I bought Apple stock because I want you to do something with the money. I didn't buy Apple stock so you can give me the money back. I buy Apple stock because I expect Apple to be smart about doing something with the money. And that's what people don't understand about buying management teams. You want to buy a management team that does stuff with the money. So, first of all, God bless Jeff Bezos, because the dude actually does, right? He takes every cent and puts it back into growing the company, and he comes up with a different idea every single week about what to do with the money, including buying freaking newspapers. He doesn't care. Well, they might have done it privately. I don't think Amazon is Washington Post. But you know, he's buying robots, he's buying systems, he buys small little companies, he starts services. He's doing something with the money to make more money, and that's the story he sells his investors. Elon Musk too. I mean, frankly, doing something with the money. At least he's doing something. You know, GE is sitting on a ton of cash, and they're like, I don't know what to do with it. That's not a good management team. So either if you give it back to the shareholders, you're giving up. But if you don't give it back to the shareholders, what kind of disservice are you doing to them? That money sitting around doing nothing. And Apple's a little guilty of that too, but I understand with Apple what the problem is Apple's problem is a little different, because I understand their predicament, because they are, first of all, they're buying back their stock like crazy. They are distributing tons of money to the shareholders. They pay, in total dollars, they pay more dividend than any other company on earth. In dollar volume, not in percentage-wise. But still, they can't help it. The money keeps piling up. They make so much freaking money, they can't stop it. It's this ever-growing pile of cash. And they don't know what to do with it. Let's see. All right, so that's what Apple's worth. I mean, you know, we haven't bought any more Apple or done anything to it because we're just waiting to see what happens. And when they do have a pullback, we'll see where it bottoms out. He talks about BlackBerry sort of just being a panic. Is there a play on the downside? No. I don't. Look. It wasn't bullshit. They make a secure phone, and now everybody freaked out about security last week, so their stock went way shooting up. So everyone says, hey, doesn't BlackBerry make a phone that's basically unhackable? It's like, oh yeah, they do. That's their thing. Everybody thought that was like a joke, and that's like, and they stuck to their guns all these years, and they still make these unhackable phones. And look what happened. You know, I mean, they've been catching a wave anyway. Well, I got no reason to bet against them. I could care less either way what happens to them. I mean, they're just a small phone company now that makes a niche product that might do good or might not do good. But I just can't see why would I short it or why would I go long. I mean, down here I might have actually thought about going long, but they don't make any money. I'm pretty sure they don't make any money at all. I think they were losing an alarming amount, BBRY. See if I'm right about that. Yeah, alarming. They are losing an alarming amount. They lost $1.2 billion on $1.3 billion in sales. Not a company I would own. That's crazy. I mean, it's a pointless company. They've only got $700 million cash. I mean, you're right. They probably are a good short, but if they get a contract to start building like a ton of phones, then you're screwed. Don't forget these phones are $1,000 a piece, right? I mean, even if BlackBerry is cheaper than Apple, but technically a phone's $1,000 a piece. So if they sell 1 million phones, they have $1 billion in sales. They could double their sales by one company ordering phones. So you want to bet against that? It doesn't make sense. There's a possibility they could pop. I mean, I wouldn't buy them because of this. Obviously, they only have $1.3 billion in cash. That's how much money they lost last year. And if you look at the thing, what are they projected to lose? No, for some reason people think they're going to make a profit this year, so they might make a profit this year. So again, who knows? I find it hard to believe they lost $1.3 billion last year, now they're going to make a profit. But we'll see. But again, I just, one way or the other, it's like, well, I just don't have that much of an opinion to go long or short those guys. Not sure you reflected the 4.6 Amazon update in the portfolio summary. What 4.6 Amazon update are we talking about? I'm not sure what you mean. We supposed to make a move on 4.6 that didn't get in there? Because if we did, I have to fix it, that's all. If this TF move reminds me of last fall, the Fed keeps rate low given Trump drama. Yeah, I think if this is where we are when the Fed is getting together, they're going to have to say, no, I think we better stay steady. They don't want to throw another wrench into the works. But they don't have a meeting for a while, so I don't, they just got to wait and see. Have you heard anything about the Fed going to digital cash to get rid of physical cash? I think all countries want to get rid of cash. What do we do then? We use digital cash. What do I care? I use digital cash now. I pay everything with a credit card or my phone. God, I love paying with my phone, by the way. It's so much better than a credit card. So what do we do? What do you need? What's the problem? I mean, digital cash is. I mean, all our cash is digital anyway. I mean, the cash is an illusion. It's just sort of like paper money the government prints to give you the illusion of having something. There's nothing real about it. The actual money is the digits in your bank account. That's your money. The cash is a very tiny representation of the actual cash that's out there. Not enough cash in our system, so taxes will have to increase on us. Yeah, well, that's the point. They want to make sure that they know where every single dollar is. But you can't think of money like that. That's not how money works. It's money is a complete abstract, and we're sort of fooled because you have this thing called money that you can touch. But the thing called money you can touch has no more reality than a Bitcoin does, which you can't touch. Although they have pictures of them, which makes it even more confusing to people. There is no Bitcoin. There is no actual thing with a B on it that's gold. That's just their symbol. If there were, it would be contrary to the whole thing they're trying to do. But all cash is like that, and the bank, just for convenience sake, gives you these bills that have numbers on them so that you can manually transfer money. But that's all you're doing. That when you're 100. If you have a $100 bill, all you're doing is manually transferring 100 units from your account to the person you handed to's account, or to them. Then they put it in their account. All you're doing is a very slow electronic transfer. Okay, but there's no money. The money means nothing. It's just printed. It's just ink and paper. It has no value. It only has value because the government says it has a value, and we accept it. If either the government didn't say it or we didn't accept it, if either one of those things happen, the money becomes worthless immediately. It's nothing. If it wasn't illegal to print your own, you could just print your own. There's nothing special about it. It's paper. It's paper and ink. And they put some stuff in it to keep it from being counterfeited. But that's the only value, and that's true though. The way the government protects their currency's value is by making it hard to counterfeit. Therefore, it becomes valuable in that it's hard to counterfeit. A Bitcoin is harder to counterfeit than currencies so far. But by the way, we start putting quantum computers out in the wild. There are quantum computers now that are in labs. When the Russian mafia can buy a quantum computer, and they've got the money for it, they'll buy a quantum computer. They'll build their own from a kit when it's in Popular Science. They'll go, oh, that's how you do that. When they have quantum computers, they will be able to crack anything, probably including Bitcoin. And then that's worthless. So that's, I'm not really in favor of going to digital currency because I think that eventually everything digital will be hackable. I think that's going to be a big problem. But there's barely solutions to these things. It's really tricky. But we'll just go with the flow. And you know what it is? I don't care because whatever system they come up with, we'll figure out a way to make money on it. So, there's always holes in the systems, and then all we have to do is figure out where the holes are and how to make the bet. What, are we getting weaker? Oh God! Oh, that's so ugly. Wow. 5,600 on NQ. 2,350 here. We've got 20,600 here. So look at that Nikkei. Ow! That's awful. What a catastrophe. How's oil doing? Oil's holding up. Wow, this is very sad. Here's a poor little dollar down 94.50. Imagine if the dollar got stronger. What a disaster. This is very bad, folks. If we finish down here, we are very, very likely to leg lower. I would guess about another 50% at least from where we are now. Maybe double this drop by the end of the week. So that's not good. So I do hope everybody's got some good hedges. So let's see how we're doing. All right. Which one's this? So here's the short-term portfolio, 448. That was about an hour ago, right? 453, $5,000. Very nice. Okay. The long-term portfolio, how badly are we getting hit? Oh, you know what? Oh, it's 331. So we only lost a couple of thousand on the long-term portfolio. That's good. You know what's helping us here is I think the VIX is helping us a bit. The 5% portfolio, or the options opportunity portfolio, that is. Very nice. Holding steady. Oh, I'm so proud. All right, good. And the butterfly portfolio, 218. That's taking a little bit of a hit because now the butterfly portfolio is not hedged, but we had other positions and we'd like them to come down. So overall, it's working in our favor. Our biggest problem in the butterfly portfolio is we had several positions that got a little too hot on us. And I'll be doing a review on the butterfly portfolio tomorrow, and also the long-term portfolio. Oh, that takes me so long. I hate that. All right. Oh, I'm not going to do a full review. I think I'll just change it. Let's do it now. Long-term portfolio. Let's only look at things that are May. That's the most important thing. If there's anything May that has to be done. Armor REIT, we'd like to put some calls against that at some point. January, December, January, great. September, don't care. Jan, great. September, January. Ah, I love it. August, January. Wow. January, July. January. Wow. June. Woohoo, that's close. Oh yeah, they come up a lot. Pearson's good. Look at a big comeback for Pearson. Look, we're barely down now. January. This one's got to get changed to the new symbol. January. Look at that. There, we're done. My LTP review is done. Nothing. No changes. I love this portfolio. Look, don't worry. This is very, very, very. I want you guys to understand. We have literally done nothing in the long-term portfolio, and the last time we did anything was April. I mean, we might have added a position. I don't actually remember. I'm sure. I imagine we must have added something, but aside from like adding a position or something like that, we didn't do anything since our review in April. Well, that's a short-term portfolio. This is the long-term portfolio? Wait. Short-term review. If that's the short-term review, why is that the long-term portfolio? Long-term portfolio review. Okay. Whatever this number is, I'm very care about. Okay. So 1297. So on April 9th, we were at 1.297, and now we are without. This is how much work we do. 1.331. So $30-some odd thousand in a month, and we've done nothing. Oh, I'm sorry. This number should be much higher because we're getting screwed on Silver Wheaton, I think. No, maybe not. No, the numbers are there. No, I take that back. This is right. Because here we have the numbers. In the other portfolio, it took it out. So we've got $33,000 profit, and that's not counting the profit on the short-term portfolio, which actually improved a lot. But in just the long-term portfolio, $33,000, and that literally is how much work we do. We went like this, we went nothing, 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 and we cashed out a few in the last one. Where is it? Yeah, I'll show you what we did. We were looking to cut back positions. In fact, here we had, we only had 953 cash. So now we have 1.1 million. We added 150,000 in cash by cashing out positions. So here's the review. CCJ, we killed it. Encana, we killed it. Intel, we killed. Lilly, we killed. Target, we improved our target position because we want to stick with it. Wells Fargo, we killed it. GNC, we pushed that position because we liked it. We want to keep it on the way down. Apple, we adjusted. ABX, we bought it back. We killed that one. CMG, we killed that position. FCX, we bought back the short calls. FNF, we sold some more stuff. Gilead, we adjusted. IBM, we bought back the short calls. LB, we adjusted. OIH, we bought back the puts. Silver Wheaton, we bought back something. We gave ourselves one side on Silver Wheaton. And that's it, it's over. So, and that was, by the way, a big one because it was on the April adjustments we were adjusting for. We had a lot of things to do because we had just positioned a lot of things that were expired in March and April. We had a lot of contracts then. Now, as you see, we have nothing to adjust. We have absolutely none of these. Everything is moved already. We have absolutely nothing to do a month later in the portfolio. Not one position that we need to really worry about. So if you can do that and make, we made 33,000. Even if you count the whole million, I mean, frankly, we're not because we only started with 500,000. But let's call it a $3,000 gain for the month. So it's about a 3% gain for 1 month. And what else do you want to do with a long-term portfolio? That's the way you should manage the bulk of your money. You should barely move it, and it should be constantly bringing in more cash. But then you have Apple's problem, right? Which is what we have. We have $1.1 million in cash. We're like Apple. We keep making money. Every month, more and more money comes in, and we have to figure out, we don't necessarily have any good things to do with it. So we sit on a very big pile of cash. But we do that just like the best companies in America are doing. And also, it's not stopping us from making really good money. So it's like it is a nice, relaxing system. I really want to just keep hammering that point home to people, is that this is a much more relaxing way to make money. It does take a couple of years to build the portfolio, but once you build it, it's like a little money machine that keeps spitting out profit. BlackBerry stopped making phones last year, sells software and services now. Still has the best encryption software system. Wow, okay, so they make phones. Why can't they make any money? Is that, did they write off? Maybe it's because they wrote off all their phone stuff last year. That might be why they have that big loss. So it's possible they may not be such a bad thing. But again, it's just not, for me, it's not worth getting into. But that does sound interesting. Now, I'd say if there's some indication that the service is doing well, or that they can license their technology somehow, that might be worthwhile. But again, it's not a play I would get into. How do we plan for Pence presidency? God. I don't think it's not going to be better. It's just going to be different. It's a different kind of horror show. But it's all the same policy crap. The policy crap is what's going to kill it. Oh, I see. That's right. That's a good example. I haven't seen the show, but I read the book. That's funny. Yeah, that's not good. So many possible not good things are coming. It's not. That's why I've never understood why the market was so hot. Oh, look, it stopped going down. All right, so now we've got to watch it and see how bouncy it is. That's the next thing to worry about. So quickly on the S&P, because I got to get going, but quickly on the S&P, if you look at the futures, and then we refresh this and make sure it's good. Not days, that's never helpful. Hours. All right. So from 2,400 to 2,360 is a 140-point drop, okay? A bounce would be 20% of the drop. So call it a 150 points. So let's say we'd be looking for 140. Yeah, let's say we're looking for 30-point bounces. 20% of the drop. So you're at 2,360 now until you're back to No, I'm sorry, it's totally off. It's not 2260, it's 2360. So it's a 40-point drop. I apologize. It's only a 40-point drop. That means you're going to have an 8-point bounce. And that means that the weak bounce from here is 268. That's a weak bounce. And you can see here on the way down, 268 was a significant area. So that's going to be your weak bounce. And unless you get over that today, we're probably heading lower. Tomorrow, you want to see a strong bounce, so you're going to add another 8 points to 2368. That takes it up to 76. So basically this line, the 2375 line, if we're not over that tomorrow, we're still in a downtrend. And you can imagine it being drawn, right? Like think about it if it's being drawn, and tomorrow we only end up here, a day from now. That is going to look weak, right? Despite the fact that you bounced off this, you're still in a pretty big downtrend. And that's what the 5% rule tells us. It tells us it's much more useful than TA because the 5% rule tells you how the chart will be drawn. So I know now what the chart will look like. If it's going to be bouncy, we're going to get over 2368. We'll consolidate there. We'll move up to 2376. And if we break out there, it's bullish because then you look at this thing, it'll look like V, and you'll say, oh, it's just a panic dip and then we recovered. That'll be bullish, right? So over 2376 is bullish. Failing 2376, so then you say, okay, now we're starting a downtrend. So that's what we're going to be looking for tomorrow. All right? So I hope everybody learned something today. And we didn't have anything too exciting to do. Now I would play for the bounce into the close because there's just so often a bounce into the close. So I would take the 56 line on the NASDAQ, since the NASDAQ is often bouncy. Yeah, I would play this one because I try to catch you. If you get a little bit of a weakness, I try to catch these guys at 56. These guys, the Russell at 37.50, or if the Dow goes over 206.50, I could play that one with tight stop. So if you want to play, I would play right now. I'd play for a bounce into the close and hope you get that weak bounce. You see this 2.5% line, though? You've got to get back over that 2.5% line at 13.59. The whole thing's not going to work. That's a big line. But that's if you want to play the futures, you can say, okay, let's just play 4 bounces, off and a bounce. Maybe they won't be, but there's off and a bounce. And like I said, so the only thing I just added today, I think is the only thing I added today, was $1 long. We're going to wait until next week and see how that plays out. And look at gold. Gold came nicely up. Gold hit 17, very nice. And the coffee, like I said, we left too long on that one. And we went in and out of the Russells. So that's it. Otherwise, we don't have anything open. All right, so next week, the big play we're going to be watching for the week then is going to be $1 long, and hopefully we'll be in better position next week. And coffee was still long. All right, thanks, guys. Have a good day.